Hi, welcome to another video session with Tankrich. We're going to continue our video series on Warren Buffett shareholder and partnership letters. Today we're going to talk about partnership letter on 1967 and 1968. Yes, two of the letters together. Before I begin on those partnership letters, let me thank you for all the positive responses that I've been getting for these videos. Please keep them coming. You can also reach out to us on our Twitter handle, which is Tankrich, to let us know how we can improve this video series. Now, let me quickly jump into the 1967 letter, which I've got with me here today. Now, what I want you to take away from the 1967 letter are three important lessons or key takeaways from the 1967 letter. And the first one, which is a very important one for this video, is how different approaches in investing make money. So when someone comes and tells you that there is only a single approach to make money in equity markets, show them this letter and they would be proved wrong. Now, what are those two different approaches which Warren Buffett is talking about? Let's quickly jump onto those ones straight away from this 1967 letter. And what I would do is I'll probably quote Warren Buffett from this letter. That will help you and understand what different approaches he was talking about. The first one is buy the right company and the price will take care of itself. Obviously there was something else also written there, but I'll let you think about it for 2 seconds and consume it. The second approach was buy the right price and the company will take care of itself. What Warren Buffett is trying to say is either you focus on the qualitative parameters. So you buy a fantastic company at a fair price and let the fantastic company run for years and give you good returns. Or the second option is you buy a company at such a magnificent price that the price alone would give you a substantially good return because you've bought it at such a huge bargain. Now, what does he opine? He says that both of these investing approaches have made money over the years, and one can follow either of the approaches. But what he says is, and it is so often the pleasant result in the securities world, money can be made with either approach. So, irrespective of whether you are following the qualitative approach or the quantitative approach, you can make money in equity markets. Now, what is more significant, which is something which you should pay your attention in this 1967 letter was, however, it is an infrequent occurrence as insights usually are. No insight is required on the quantitative side. So, when you want to buy stocks because of qualitative reasons, you would need insights into the business. You would need to know the business better than anyone else or better than any other analyst which is tracking that business. But when you are really buying on the quantitative sides, on the maths, on the numbers, then it should be really evident. If things are selling below their cash value, or if things are really selling at a huge bargain, they should be very evident, and you should be able to see them straight away. So those are the key differences between those two approaches. Approach A requires insights. Approach B is very evident and should be visible to any genuine investor. But both of those approaches work in investing, and people have made a lot of money using both of those approaches. That was the first key insight which we got from the 1967 letter. The second thing, 1967 letter was 3 to 4 pages. There were things which were repeated, like in Law's letters, he likes to use a storyline and then convey message to his partners. So I would not tend to repeat things which we've already talked about in previous videos. But the second thing is where Warren Buffett has called out that, and in 1967 there was a difference. In 1967 he changed his objective for the partnerships. He lowered his expected returns because he felt that the equity markets and the business situation has changed. His personal motivation has changed. So he lowered his rate of expectation and in turn his rate of expectation from partnership as well. So that was another key thing. When business environment changes, when your personal motivation changes, when incremental capital is not adding value to your personal life, think about the returns that you're expecting, and obviously the base was increased. So with time, Warren Buffett also changed, and he lowered his expectation. That was the second and most important message that we got from the 1967 letter. And third was again very subtle. This message was around what is the comfortable rate of return, which Warren Buffett was comfortable at that point of time. Remember, he had made his millions over the last 10 and 11 years. So at one point of time in the letter, he says that he is happy with 10 to 12% of return on capital employed. For him, that was adequate enough on his controlled situation. Now remember, as retail investors, we would be in a different situation from what Warren Buffett was in 1967 when he was controlling 3 to 4 companies. But in his control situation, as long as they were making 10 to 12% return on capital, he was happy with them. So if you go to an investment guru, they will say that we need return on equity, return on capital employed of more than 20%, 25% to own them. But here Warren Buffett was owning control situations, and he was happy with 10 to 12% return on capital employed. So that was really great. So those were our key 3 learnings from the 1967 letter. Now moving on to the 1968 letter, which again I've got with me here today. 1968 letter was again having a lot of things which were common across his letters from 1959 onwards, so I would not tend to repeat them in this video. What I would point out is one important thing and one bonus thing. So we'll talk about the bonus at the end of this video, but one important thing which he pointed out. Now, for your reference, the 1968 year was the year when Warren Buffett actually murdered markets. So if you really look at the return percentages, he really made 58% on a such large base of partnership in the year 1968. So almost to the tune of 60%. So he was really making, and he was murdering market. Now that was not something which, if we can do it and if we learn it, that's something as a bonus which we would take away from this letter. But really the most important line for me in the 1968 letter was where he said that price is what you pay and value is what you get. Many a times as retail investors, we never get this very simple message that value and price are two completely different things, and many a times the value and the price will have a difference, will have a divergence on the way they are moving. Understand, if you are able to ascertain the value, and if market is giving you a favorable price, you go and buy that value, because that is what you are getting, not the price which you are paying. It is very difficult. It is something which comes with a great training and practice, that we are able to see a difference between value and price, given the way equity markets operate, and given the way things are quoted on a daily basis, hourly basis, on a second by second basis. We tend to get delusioned by this price thing. But really, if you want to make want to make good money in the equity investments, you have to understand this very small principle, that price is what you pay, value is what you get. So that was one of the key messages for me in the 1968 letter. Now, as I told you in the beginning of the video, for 1968, there was a bonus for us, the investors, in the 1968 letter, and that bonus was a book recommendation from Warren Buffett. So Warren Buffett, in his previous letters, have always gone back and talk about his mentor and how the intelligent investor has played a key role in shaping up the thinking and shaping up the investor that he was. In 1968 letter, there was another book which was mentioned. Any guesses? Alright, so the book was Money Game by Adam Smith, and Warren Buffett actually pointed out, and I'll probably quote him from the letter. He says that the Money Game by Adam Smith, it is loaded with insights and supreme wit. So he really liked it, and if the great man likes it, then definitely this book should get on our reading list. So that was a bonus item which we got from the 1968 letter, in fact. So those were our key learnings from the 1967 and the 1968 letters. Obviously, pretty concise, not really on an expanded scale, which we have seen in other videos or from our other letters, but really key learnings that a retail investor can use, make successful investments, and become a better investor. So I hope you are liking this series on our Warren Buffett partnership and shareholder letters. We will continue to bring you investing insights from future letters. Do keep watching. Hit the subscribe button if you're liking stuff here. And I would really wait for your feedback and comments on this. Thanks for watching again. I'll see you. Bye.